We start off tonight with a sea of green on Wall Street today. The market seeming to shrug off record high reading on inflation. The S&P rising over 1%. The Nasdaq up more than 2%. This even as producer prices rose a whopping 11.2% in March. But is this positive market action actually a bad sign? One of our traders says this could give license for the Fed to be even more aggressive. Brian Kelly, explain your contrarian thinking here.
Yeah, well, I've had to do that a lot of times in my life. But in terms of the stock market, what I'm thinking here is we talked about the consumer, right? Planes are packed. Vegas is packed. All these things. Spending hasn't stopped. But what the Federal Reserve wants is you not to spend. That's how they're going to control inflation. So they've been worried about this wealth effect. We've talked about that for the last 10 to 15 years, which translates into the Fed put. The stock market goes down too much. The Fed eases. They want it to go up so you feel wealthy again. Now it's the exact opposite. So in my view, the higher the stock market goes, the more likely the Fed is to be more aggressive with the rate hikes because they don't want you to spend. They have to get inflation down.
And that's basically the notion that Bill Dudley put forth in his opinion piece last week. The notion that the side effects of what the Fed needs to do to the economy to slow it down should bring prices lower in the stock market. And yet we're seeing the exact opposite today, Karen. And I'm not sure what, because yesterday the notion was peak inflation. That wasn't enough for a market climb. And today it's peak inflation. And that's like off to the races here.
Yeah, you're all worked up over this peak inflation. We were talking about it before the show. I think that actually that Bill Dudley article is very interesting. I think that has been happening, not today, but if you look at the market since November, which is when they got rid of the transitory and started this idea of, you know what, we are going to start raising, get ready, and then we're going to start tightening the balance sheet. Since then, the market actually is down. It has rallied, of course, off the March lows. But I think the direction is still, I feel like pressure on stocks. The one other thing, though, is the colliding of inflation with the reopened trade. There is still that pent-up demand, even though things are getting more expensive. People are dying to go out, and I think they're dying to spend money for now. They still have money.
Well, isn't that a headwind for the Fed, though? I mean, that's sort of what we're getting at, right? So it's fighting a consumer who really, really wants to spend because they were not able to spend on these things for 2 years, Guy. And maybe the Fed has to work even harder, i.e., hike more aggressively than we thought in order for these things to kind of simmer down.
You got a lot of people saying that. Listen, BK put it out there pretty eloquently, but you mentioned Bill Dudley. A lot of other people. Listen, look at Jamie Dimon's letter. A lot of people are sort of ringing the warning sirens, but nobody seems to, at least the market doesn't seem to care right now. We'll see. But in terms of the market, it gives the Fed, I think, a lot of air cover to do exactly what they should be doing. But I will point out that, as hard as it is to get inflation, I think it's twice as hard to get rid of it. With all that said, I mean, there are sectors that have been working and continue to work. I mean, you had that brief sell-off in energy, once again, probably on the China shutdown. And this, again, ridiculous, a word I'm choosing to use, release from the SPR, which any value is short-lived. I think energy is going to continue to work. I think the resource stocks continue to work. And, despite Lilly being down today, I think big cap pharma will continue to work in this environment.
Yeah, Pete, what was your take on the market rally today?
Yeah, it was pretty interesting, Mel, especially given what we had yesterday with that harsh sell-off that we had gotten. And it was just accelerated all the way through the close. And then you turn around today, and it's almost the exact opposite. I don't know that one day actually changes a lot, but it is something I know we have plenty that we can chat about it, but I think we have to see multiple days. We've got to see something where the markets actually do show us a little something more than just a single day, I think, to really be something that the Fed can hang their hat on and feel a lot more comfortable about what sort of rate that they want to go with these rate hikes. So I think that's something that we'll all keep a close eye on. There's a lot of reasons why we're looking at volatility still above 20. It's traded today just below 22, but we were above 24 yesterday. There's interesting volumes out there. To Guy's point, there are areas of this market that have been working that I think will continue to work. And that, basically, it's energy, it's materials. I think those are sectors where you can still see a lot more upside. Take a look at Nat Gas today. Nat Gas was up, 7% or something like that, or 5%, 5 or 6%. And then you look over at the price of oil. Crude, once again, not only back over 100, but now over 104. It just shows you that there is some resiliency there right now, I think, in some of these various commodities.
You got to wonder when price increases are going to start hurting or kicking in when it comes to consumer demand or end market demand. I mean, Fastenal It's an earnings we don't often talk about, but it was an interesting earnings report today. It was a good report overall. They talked about raising prices, the ability to raise prices between 5 and 6% during the quarter. They also talked about input costs and shipping costs continuing to go higher in the first quarter, and possibly the need to continue to raise prices as we go on, as the costs continue to rise. And we heard late in the day from Amazon saying it's going to impose a 5% surcharge on third-party sellers on its site because of, in part, fuel charges, as well as just warehousing and things like that, BK. I mean, it is working through here.
It is, and this is the risk to the market. Now, I don't know if this is going to happen, but I know that the market is not pricing in this sticky inflation. We saw it today. Let's say today was what everybody called peak inflation, and we all decided on it. You saw global bonds rise, or yields sell off, go lower, right? You saw currencies, which you would have thought would have gone up when a central bank raised rates, they went down. So something changed in the market today, which tells me they're saying, hey, market's starting to price in, you know what? The more central banks raise rates, maybe we are going to get a recession. And what does the Fed do in recession? It eases. Therefore, we should buy bonds, right? But the risk in that is you get this sticky inflation and the Fed never eases, then you've got a real problem with stocks. So that's why you got to watch oil.
I sort of think the resolution of this supply chain issue is going to be the thing that will break inflation from this level to where, I don't know. I don't think 2% is the terminal rate, if you will. But I do think that when the supply chain eases up, there will be retailers who have over-ordered and will have excess inventory, and then I think you will start to see prices come down. I had thought by where we are now that the supply chain issues would have been resolved already.
Right.
Clearly, that hasn't happened, but I do think that phenomenon will exist when it does happen.
Yeah, I mean, the thing is that part of the supply chain issue involves, chip supply, for instance, manufacturing being taken offline for various reasons. But now we're dealing with bottlenecks that may not be resolved even if Russia pulls out of Ukraine and there is a ceasefire tomorrow. I mean, all of what we're experiencing, not all of it, but a lot of what we're experiencing with energy, Guy, to your point in terms of where to be in the market, will not be resolved. There won't necessarily be an additional barrel on the market if Russia pulls out of Ukraine tomorrow. And that's not going to help prices.
Not at all. And I don't think you're suggesting this, so I'm not saying you are, but I happen to think that energy prices, I mean, maybe it would take a little longer to get here, but I think Russia-Ukraine just sort of sped up the process. I'm sure I'm in the minority on that one, but the fundamentals are in place for energy months, if not longer, before Russia-Ukraine was even a headline on a news wire. So I just think the energy story is going to be here. It's going to be persistent, and prices take a long time to get, they take a long time to abate. So I think we're looking at this. We talk about peak inflation. I'll give you two words that also begin with PE. That's both pesky and persistent. And I think inflation will be both for the foreseeable future.
Yeah, persistent, sticky, whatever you want to call it. I think that could be a huge problem, especially for consumers. Pete, when you think about inflation and investing in an inflationary environment, people talk about inflation hedges, and then people also think about investing in the things that go up in an inflationary environment. Where would you rather be in an inflationary environment?
Are you giving me a would I rather, or are you just, am I picking?
Yeah, sure, call it whatever you want. If you want to say would you rather, makes you feel better, makes you, be able to think about it more clearly, then absolutely. Would you rather be in an inflation hedge or be in the things that you think will go higher because of inflation?
I think I'd rather be in the things that are going to go higher with inflation. And Guy hit the nail on the head. We've been talking about this with Ukraine and Russia. Obviously, that did give a little bit of a boost with energy prices, oil specifically. But I think the reality is that pace had already been set. And that was set nearly the day that Joe Biden became our president. And so it's something that, it was just continuing on. And it had a nice big spike. Then that pulled back. I don't even know right now whether or not the Russia-Ukraine war, if we're calling it that, actually is still having that big of an influence on the price. I think we're now just sort of seeing the shift of where is the price of crude, and I think we're seeing exactly where it is, which is most likely going to stay over 100 for a while. I think the reality is this: when we talk about peak inflation, that's fine, but I think the reality is not only peak, but will we stay here for a while? I think too many people continue to interpret peak inflation to mean, well, you know, we hit this number and now we're just going to completely drop to the downside again. I don't believe that. I think we hang around here for a while, and I think how long that is, I have no idea. But I don't think it's something that we are suddenly within days or weeks are suddenly going to be pulling back. I think we're going to be at these levels for quite some time, and I think that's why we've got to trade knowing that inflation is here to stay.
Ryan Kelly, I'll put the question to you. Gold or oil?
Oh, that's a superb question because they traded together today.
Yeah.
I want to be in the belly of the beast. I'm long both of them, but I think you want to be long oil. I mean, look at how this thing has traded the last couple days. We had the SPR auction yesterday. We had a huge inventory build today. Oil dropped for about 10 minutes and then absolutely ripped higher. Bad news or bearish news, good price action, that's where you want to be. So if you're thinking about your portfolio and you're long a bunch of equities, let's call it tech, why not get some energy exposure as a hedge in case inflation doesn't start to peak?
All right.